Well, hello and welcome back to Finspire's Focus on the Markets, fourth quarter 2021 edition. It's hard to believe we're at the last quarter of 2021. This year seemed to fly by. However, today we're taking a driving theme, a driving and automotive theme, because there's a lot of things embedded in this quarter's commentary and our look ahead that are really interesting because the returns, the total returns that we saw in the capital markets this quarter appeared to be stuck in neutral. But there's a lot of things going in forward. There's a lot of things going in reverse. So our theme this quarter is, are we stuck in neutral, going in reverse, or driving forward? And we're going to tackle, we actually have quite a bit to tackle this quarter because there's quite a bit going on, not just with the investment markets, but the broader global capital markets and a lot going on in Washington, D.C. So let's get to it. First, I just want to get into how we're breaking this down this quarter. Like I said, we have a lot going on. We're going to talk a little bit about growth, a little bit about the returns that we saw in the third quarter in this recent past. We're going to talk a little bit about the labor market disruption, right? Everybody is aware of the shortages of goods, services, and people. So we're going to talk a little bit about that. We're going to talk a little bit about inflation. In fact, this quarter, we're having a special session, a special Focus on the Markets edition, separate from this broadcast today, strictly about inflation. So we'll talk more about that towards the end. And lastly, the dysfunction in D.C. It's been bad and it's been ugly. And hopefully there's a good outcome, but we'll talk about what that means a little bit later on. But before we move on, we've got a little question for you. If you're looking at this visual here of this gal driving, what do you think is wrong with this picture? Take a minute to figure out. We'll come back to that a little bit. All right, let's first hit the growth pattern, right? We have been growing economically at a very solid rate. Second quarter GDP was revised to 6.7% favorable, which is a pretty substantially high number even after the COVID GDP correction that occurred second quarter, third quarter of last year, where we went way down, then bounced way up. And now we've reached a point in the third quarter, although the third quarter GDP figures won't be released until the end of October, at least the first reading of them. What we're seeing is that we've likely eclipsed where we were from a total GDP output from where we were pre-COVID. So that's a pretty major feat. And the economy continues to perform very well from a growth perspective. So what's driving that growth? Well, interesting, today, consumption is an even greater portion contributor towards GDP growth than it was pre-recession and where it was 20 years ago. When you break GDP growth down in these components, consumption, investment, government, net exports, we can see that consumption, the importance of consumption as its contributor to GDP, has increased substantially by almost about 15% from where it was 20 years ago. And that makes sense, right? That makes sense why we're growing at such a clip, close to 6 or 7% potentially for the full year of 2021. We'll talk more about that in a moment, but with the way that consumers have been spending, especially right after the pandemic, all the way through this year, has led or contributed to some of the shortages of goods and service that are out there in the economy today. And you can see it still expanding. So whether it's manufacturing activity, non-manufacturing activity, which is just a different way of saying services, we're in expansionary levels at sustained elevated levels like we haven't seen in well over 20 years. So the economic indicators are telling us that this manufacturing rebuild, the inventory rebuild, the return to work, the return to normal is snapping back very hard. And we've also seen that it sustain itself. So this momentum, economic momentum, has sustained itself. Now let's shift gears a little bit to asset class returns. It was a mixed bag in the third quarter. And quite frankly, not a lot of change. Not a lot of change in the equity market. We were off a little bit in the equity market in the third quarter. We were up a little, ever so slightly, in the bond market. But it was a very neutral quarter in terms of equity and fixed income returns. So let's look at the horse race, right? Let's look at the auto race and see where we are from a year-to-date perspective as of September 30th of what's leading the pack and what's coming up, what's bringing up the rear. Commodities and small caps have been doing the best this year. Not too surprising about commodities. Have we seen commodity prices rise substantially, especially with this latest elevation in energy prices, and that's been a continuation of a theme from last year. Back in the first quarter of last year, commodity prices tumbled along with the equity market. Well, those have since restored themselves in 2020, and in 2021, there's been a consistent and elevated chart for most commodity prices. And we see that in our daily goods, right? Daily goods of especially in food and energy, which we'll talk a little bit about in a moment. Small caps actually had a bit of a weak third quarter, weaker than large cap third quarter, but are still up greater than the S&P 500 year to date. And I tell you what, that S&P 500 return 15.9% year to date as of September 30th is pretty darn good. So although international equities have trailed, we actually saw a correction in the emerging markets, which we'll talk about in a moment. And then fixed income is still coming in last here so far year to date. Interest rates are finally moving higher with a lot of pressures with elevated growth rates and inflation concerns, which we'll talk more about in a moment. All right. So one of the things that we track real closely here, and we think it's pretty interesting, is to measure when markets pull back in nature. And when we define a pullback, we typically define a pullback as 5% or greater, right? And we haven't had many of those. In fact, we didn't have any until the very last day, just about the very last day of the third quarter, where we finally got our first 5% pullback in the S&P 500 on the year. Typically, we see anywhere from 4 to 5 of those types of pullbacks in any given calendar year, but we just reached our first one at the end of September. Nevertheless, in the S&P 500, despite a 5% drawdown, recently still 16% growth in the S&P 500 returns so far year to date. And you can see the pattern. It's pretty normal to have significant drawdowns in every calendar year, even when the market pulls higher. And this year is no exception, although for the first 3 quarters we were close to looking like 2017, where we actually didn't have one single 5% pullback. You can see the greatest pullback we had back in 2017 was minus 3%. So let's take a look at the asset class that had the U-turn. All right, and that was emerging markets. A lot of things contributing to emerging market pullback. You can see the pullback in the third quarter was minus 16%. So if you had a diversified portfolio like we practice, and there's a dedicated element toward emerging markets, that specific position would have come down. Probably some of the international equity positions would have been drawn down a little bit more than normal, primarily due to emerging markets. And when you dissect that further, it has a lot to do with China. China's, as part of the emerging market index, represents approximately 40% of that index. China really curtailed monetary policy earlier in 2021, and then, of course, had this Evergrande issue with real estate debt. It seems that it's been isolated to China. The thing is that China is the second largest economy in the world. So whenever we say, or you hear someone on the financial press say, well, it's just limited to China. Well, China being the second largest economy can have anything debt crisis related, especially in Chinese real estate, can have a pretty significant impact on the capital markets, even if it is just isolated to China. So that occurred in the third quarter. Like I said, there was a lot going on behind the surface of these numbers, and that was one thing that we watched real carefully along the way. The sector rotation. The sector rotation has been real. Since November of last year in particular, we saw a big rotation, not just away from technology. It's not like technology has done poorly over the last year. In fact, year to date, technology returns are right in line with the S&P 500, right around 14.5%. But it's been the rotating sectors that were starting to be favored at the end of last year, all throughout this year. Energy, financials, real estate have done very well. And those are traditional, what we call value sectors. Okay, growth sectors being predominantly technology, but energy, financials, real estate have continued to perform very well, and they have really since November of last year, and even a little bit before that. So this rotation towards value continues to occur. All right, let's go to the next part 3 of 5 here, which is the labor market. As we know, it has been everybody we speak to, all of our clients on the corporate side, it has been a real challenge to hire in most circumstances. And there's a number of reasons for that, and it's very systemic. What we saw recently here is the unemployment rate fall down, although as of the August 2021 reading, it was 5.2. It actually went down further with the September numbers to 4.8. Wage growth, however, and not too surprisingly here, when there's a tight labor market or a big demand for labor like there is now, wages tend to rise because workers can command a greater salary or greater salary increases when they see it happening all around them. And that's what's happening here. The last recorded wage growth number is at 4.8%, which is a pretty sizable figure that can drive inflationary pressures higher. Historically, what we've learned from the behavior of markets is that when wage growth creeps above 4%, it starts to decay earnings in corporate financial earnings. But we'll talk a little bit more about that in a moment, because that is an interesting aspect here, especially with corporate earnings. Job openings, you've probably heard this, job openings are plentiful in the economy. In fact, this same JOLT survey, job openings and labor turnover survey, recently reported a record number of people quit their job last month. So we have more openings than there are a number of people looking for work, and that's primarily because the labor force participation rate has remained low, has not caught back up to where it was pre-COVID, which means there are just simply fewer people looking for work. There's a lot of contributing causes to that, but that is what is driving some of this, also contributing to some of this wage inflation that we see at the workplace. All right, shifting gears, we mentioned, we've talked about it multiple times already, but this inflation concept. Inflation has been stubborn. This concept we talked about a couple quarters ago, and last quarter in particular, about the Federal Reserve and other prognosticators saying that inflation is transitory. It's kind of tough for inflation to be transitory for a short period of time, which is what I would describe it as transitory if it was here and gone, especially when you have such a tight labor market and a shortage of goods and services and freight that is stuck, for example, in the Pacific Ocean trying to get through the LA port, freight full of goods coming in from overseas. And this is why you see CPI, Consumer Price Index, even when you strip out food and energy, which we know if you go to the gas pump, if you go to the grocery store, prices are elevated. It's not just in food and gas. It's also across the entire economy. It's in rents, and it's in other areas. And you can see the CPI rose 5.3 as of the last reading back in August. And then very recently, if any of you are collecting Social Security benefits, the cost of living adjustment was substantial. They recorded a 5.9% cost of living adjustment in Social Security payments starting next year. So inflation is real. It's here. And the question is, how stubborn will it get? Because what we still find is in not just consumer price index, but CPI, but also in producer price inflation. This is the cost, the increase in the cost of building products, building goods in the economy. You can see producers are paying over 8% more than they were a year ago. And this number has not only been stubborn, but it's actually, you can see it's been on the rise. So we'd like to see some of these figures come down. The other area that's been stubborn has been oil prices. We just here in the United States are producing about 11 million barrels a day, 11 million barrels of oil a day versus pre-COVID. We were producing about 13 million barrels a day, yet the economy is growing. And that's one of the reasons supply-demand mismatch has caused oil prices to rise. And in connection, energy costs such as gas for your car, perhaps heating oil for the winter, right? The cost of natural gas has gone way up. So the cost to heat your homes this winter, for those of us up north, is going to be perhaps substantially higher than the way it was a year ago. So we're seeing inflation in commodity prices as well as the traditional goods and services. So where do you go for yield? Well, interest rate, typically a lot of people go into the bond market for yield and for income. And what we've seen here are interest rates that have really picked up over the last, in particular over the last quarter. In fact, we've seen interest rates pick up above where they were last quarter, at the end of last quarter, and substantially higher from where they were to start the year. So the yield curve here, although short-term rates in that very low left corner are still at zero, and the Federal Reserve has indicated they're going to leave them there, although they're starting to take away some of the stimulus that's been going in, and some of the liquidity that's been being injected to the capital markets every month. Here soon, you can see that interest rates have been on the move. However, I will say that the demand for income globally is so high, and our yields are here in the U.S. are substantially higher than they are overseas. It is tough to tell just how far these yields will rise because of that global demand. If interest rates rise and yields rise, global demand for income could push that yield curve right back down where it was. And we're seeing a little bit of that here in the first part of October. But the big question mark is the logjam, and the last part of our comments here are really related to dysfunction in D.C. We warned you last quarter that this would get a little ugly, that this whole concept of tax and spending bill known as the reconciliation package is going to be working its way through Congress, and it's not going to be pretty, and it hasn't been. So up for grabs, although there's a seemingly an agreement on general infrastructure spending, which is around 1.2 to 1.4 trillion. The big wild card is this $3.5 trillion House proposed tax and spend bill, which seems to have gotten some, especially some people in the middle of the political spectrum, very uneasy on the left. And you have those on the right who are essentially unanimously against something like this from occurring. So we're at a logjam, we're at a traffic jam in D.C. It is pretty ugly. We'll see what happens. And the sensitivity is around, gosh, if we have this inflation problem, if we inject another $3.5 trillion plus into the economy, into the capital markets, are we just going to get more inflation and more stubbornly high levels of inflation? And that is very concerning to markets. So this is something that we're keeping an eye on very closely as we watch it unfold here, especially over the next couple months. Taxes, of course, are a big concern, right? So embedded in a reconciliation package, by definition, if you spend $1 trillion, you got to basically raise revenue by $1 trillion in order for it to be eligible for the reconciliation process. So what does that mean? That means the potential for higher tax rates. So just to give you a sense, we just had recent tax reforms, which back in 2017, which really went into place in 2018. So this potentially would be a big reversal of the direction that where our country was headed for the last couple of years in terms of lower tax rates. And now we are talking about adjusting personal income tax rates, capital gains tax rates, estate tax rates, et cetera, and others, corporate tax rates, in order to pay for whatever type of spending package Congress decides to move through, if they decide to move through one at all. Okay, so let's go hit the highlights one by one. Slower but positive economic growth is here. So growth is still high, but it is slowing a bit. And this is important because corporate earnings, due to all the economic activity so far, have done well, and even early third quarter earnings reports have been very strong, and the markets have been appreciating that and allowing stock prices to be supported and perhaps even move higher here of late. Even after we finished the markets in a weaker third quarter stint, it does appear that the earnings are keeping pace with elevated stock prices. But that being said, we're anticipating slower growth because the current rate of growth is quite elevated, but we're expecting slower growth into 2022, but still positive. The performance pause in the U.S. may be over. It may not be, but it looks like signs in early October say we're actually back on an uptrend here in October, and we're looking forward to seeing that translate into the emerging markets, and that would be very, very healthy for those diversified portfolios. The labor market is still struggling with the dislocation of the number of people looking for work and the number of open jobs available. People are quitting at a record rate, and this is going to be a very uneven monthly series of jobs reports and unemployment rates and labor force participation rates. But it's really important because at the end of the day, economic growth is driven by the number of people working multiplied by their output. And so we want to see that labor force participation grow in order to keep economic growth perhaps surprising to the upside. Inflation is here. But right now, the economic growth is offsetting some of the movements in inflation. This is one area that we're going to dive into more with our special guest that we'll have about inflation later this quarter. That right now, with higher levels of economic growth and elevated moves in the equity market, that is somewhat offsetting the movement of inflation. But will that last? In other words, will we go into a slower growth period and still have stubbornly high levels of inflation? If we do, that could be very problematic. Okay, not just for our portfolios, but also economically, it could create a lot of consternation inside the economy. Lastly, and that takes us from that last point right into the budget reconciliation package. It is a lot of things are hanging in the balance. Spending, taxation. We're talking about trillions upon trillions topped on an already multi-trillion-dollar deficit, and which could ignite further or allow inflation to remain stubbornly high at stubbornly high levels. And so we're going to be watching this very closely here in the fourth quarter. So, as I mentioned, stay tuned. We have a very special, an inflation special. Okay, it's not going to be as abbreviated as what we do here with a quarterly recap. If you're really interested in the inflation topic, we're having a lot of discussions with clients, not only about their take on, especially with producer price inflation, but also just the inflation concept in general. And the reason is, most investors have not been through a period of elevated inflation and lower growth since the 1970s. So we want to dispel and demystify some of the concepts around inflation and its impact to the capital markets and to investments and to investment portfolios at that special. So more to come on that. As always, these are our opinions shared with the facts that we know on the ground. And lastly, we wanted to say thank you. I'm fortunate here at Finspire. We've added 3 new team members this year, and we have us at Finspire. Please feel free to reach out with any questions to our team. We've been getting a lot of good ones over the last couple of quarters. Feel free to reach out over email, over phone, etc. And we're happy to get back to you and answer all of your questions where we can. And if we don't know the answer, we'll certainly help you track it down and find it. That'll conclude this quarter's, the fourth quarter 2021 commentary on the capital markets and our focus on the market series. I'm Chris Karam signing out. We'll talk to you real soon. Thank you.